All right, let's jump right into this explainer. There's this fascinating story that proves making money means absolutely nothing if you don't actually know how to keep it. We all dream of hitting the jackpot, getting that massive salary bump, or coming into sudden wealth. But wealth is a remarkably fragile thing.
Take this unbelievable case from the source material. Back in 2011, KBC winner Sushil Kumar walked away with a cool 3.5 crore rupees. That's 35 million rupees after taxes. Just pause and think about that for a second. With even a basic understanding of finance, that staggering amount could have easily snowballed into 10 crore rupees by 2022 through simple, passive index investing.
But no. Instead, because he just didn't know how to invest, he shockingly went bankrupt, lost the whole shebang. It brilliantly illustrates exactly why we must learn how to manage our wealth. Making money, that's really only half the equation. Keeping it and growing it is the true challenge. So, to make sure you never face a fate like that, we are going to group the 10 most critical mistakes salaried professionals make into a 5-step financial pyramid. We'll cover the silent wealth killers, building your financial defense, smart asset allocation, managing cash flow and debt, and finally, your ultimate financial vision.
Starting right at the foundation of our pyramid, Phase 1, the silent wealth killers, battling inflation and macroeconomics. To really put this into perspective, historically speaking, the US dollar has lost approximately 96% of its buying power. 96%! It just shows you how incredibly fast money decays over time. If you're out there thinking that keeping your cash stuffed under a mattress or simply sitting in a checking account is safe, you're actually mathematically guaranteed to lose.
Bringing this a bit closer to home, if we assume a 7% inflation rate in India, the math proves exactly why your true goal of investing absolutely must be to beat inflation. Think about it. 1 crore today will feel like just 50 lakhs in 10 years. Give it 20 years, that same 1 crore will have the purchasing power of just 25 lakhs. It's wild. A fundamental mistake people make is thinking investing is just about getting super rich, when in reality, your absolute baseline goal has to be outpacing inflation.
And this comparison brilliantly illustrates why your context matters so much. Picture a 30-year-old living in 1991 Japan. They could safely just leave their money in the bank. Why? 0% inflation and 0% interest rates. Their purchasing power wasn't going anywhere. But if you are a citizen in a high-growth economy like India or parts of Africa, where inflation is a constant reality, you literally cannot afford to play it that safe. You absolutely must take calculated risks to grow your wealth.
So now that we know the enemy, let's move up to our second tier, building your financial defense, focusing heavily on insurance and liquidity. Take a look at this comparison. While general global inflation, like the roughly 9% we saw recently in places like the US, is obviously a massive concern, medical inflation in India is accelerating at a staggering 14%. That is huge, and it makes buying comprehensive health insurance early on an absolutely critical defensive move. I mean, you've got to patch the holes in your ship before you set sail.
Delaying this defense, it's a massive mistake. Grabbing term insurance at age 25 rather than waiting around until you're 35 ends up saving you almost 70% on premium costs over time. The younger you are, the cheaper the defense. Get this sorted out early so a single random medical emergency doesn't just wipe out your entire life savings. Now, your defense also requires something a lot of modern investors kind of laugh at: fixed deposits, or FDs. But the source highlights that FDs serve 2 crucial purposes. First, they're the absolute perfect place to park 6 to 12 months of emergency income. Second, they give you highly liquid cash. Remember the 2020 market crash? The folks who made crazy once-in-a-lifetime returns were the ones who had liquid cash just sitting in safe spaces like FDs, ready to deploy the second the market tanked.
With our defense totally secured, let's look at Tier 3, smart asset allocation. Expanding your investment horizon. We so often mistakenly limit ourselves to paper assets. Cash, FDs, stocks, they're all paper. But to truly bulletproof your wealth from systemic shocks, you've got to understand and acquire non-paper assets. We're talking about investments where the government has very limited control or intervention. Things like physical land or physical gold.
And why is this so absolutely vital? Simply because governments can print money endlessly. The source notes that the US actually increased its money supply by an astonishing 300% between 2020 and 2022. That literally dilutes the value of every single paper dollar you hold.
Spreading your bets across physical real estate, physical gold, and, as some investors neutrally view it, Bitcoin as a digital property strategy can act as a serious hedge against this exact type of money decay.
Furthermore, blindly trusting government schemes without running your own math is a classic trap. For instance, take a scheme like the Sukanya Samriddhi Yojana. Locking in 10,000 rupees a month for 21 years at a 7.6% yield gets you about 42.4 lakhs. Sounds pretty great on paper, right? But mathematically, over 21 long years, it barely scrapes past inflation. Historically, you'd see much higher returns dumping that exact same money into a highly liquid, incredibly simple index fund.
Which brings us to a huge pitfall. The source offers this golden rule. Work on your own investment system, not on borrowed conviction. Whether it's your uncle at a wedding pitching ITC stock or some flashy ad pushing the latest mutual funds, relying on someone else's borrowed conviction means you're never going to actually know your true entry and exit points. You have to build your own thesis.
Moving right along, we ascend to the fourth level of our pyramid, managing cash flow and debt, the rules of leverage.
Now, taking on loans isn't inherently evil, but you've got to know the difference between good debt and bad debt. Taking unproductive loans for depreciating assets, like cars or the newest iPhone, is a severe wealth killer. It just drains your CIBIL credit score, which totally impacts your ability to borrow cheaply later and offers zero tax rebates. Productive loans, on the other hand, like those for housing or land, can actually help you leverage your money while providing you with offsetting tax benefits.
If you're not careful with your cash flow, you risk falling into this incredibly dangerous cycle. Step 1. You over-leverage yourself with super high EMIs. Step 2. A sudden financial emergency hits out of nowhere. Step 3. Because your cash flow is suddenly negative, you're forced into a distressed sale. You end up liquidating your hard-earned investments at a fraction of their actual value just to survive. It's a total nightmare.
So, to prevent that exact nightmare scenario, the source provides an absolute golden rule for debt. Never, ever let your total EMI payments exceed 30% of your total monthly salary. Keeping your debt obligations strictly below this threshold ensures you maintain a positive cash flow. It keeps you safe when life inevitably throws a curveball your way. Finally, we have reached the absolute peak of our financial pyramid. Step 5. Your ultimate financial vision: taxation and business. You know, we all complain about spending massive amounts on our kids, our homes, and our lifestyle. But mathematically, taxes are your biggest lifetime expenditure, period. Therefore, consciously optimizing your taxes is literally the single most effective way to retain the wealth you've worked so hard to build throughout those first 4 tiers on our pyramid. The source outlines this really fascinating roadmap to handle it. You maintain your day job, sure, but you start building freelance revenue on the side. Once you hit a 20 lakh turnover, you register for GST. And that unlocks some unbelievable advantages. Say you're buying a 1.18 lakh rupee phone for work. You can actually claim that 18,000 rupees of tax back as a GST input. So having a business vision isn't just about entrepreneurship, it acts as a massive tax shield. Well, as you look at your own financial pyramid and everything we've unpacked in this explainer today, you've really got to ask yourself one provocative question. Are you actively taking control of your financial destiny and building your own vision, or are you just surviving on borrowed conviction, leaving your wealth to be totally eroded by the silent killers we talked about? The choice, and your financial future, is entirely up to you.